Hey everybody, I'm Mike Gasior and this is my January 2008 video commentary. And while I want to go on the record of being officially against global warming, 1 year ago I filmed this video commentary while I was on my skating pond playing a little hockey for you. So, hard to be against global warming when I can shoot hoops at the beginning of January. But anyway, it's a new year. And I thought the most reasonable place to start the new year out was talking about the credit crisis, so to speak, which is about now 5 or so months old. And one question I get continually in my seminars, when I'm giving speeches, is how long can we expect this thing to last? And as an old bond guy, as you guys know I am, it's going to be quite a bit longer than I think people are really prepared for. Because let's revisit just first of all the nature of the bond market. Very different from stocks, bonds trade over the counter. So, if I wanted to buy or sell some of my bonds, I would call a broker, Merrill Lynch, Lehman Brothers, Goldman Sachs, Bear Stearns, and I would say to them, I would like to buy XYZ bond. They'll give me a quote, and if I buy that bond, I'm buying it out of their own inventory. It's not like the New York Stock Exchange, where your broker is simply sort of acting as your agent, buying the stock that you want from somebody who's selling it that day. In the bond market, the broker that you're on the phone with is the other party to the transaction. The problem becomes simply this. When you call the broker to sell some of your bonds, the broker is going to give you a price, but that price, if they buy it from you, they're going to be buying it at that price into their own inventory, which is where it'll sit until they find some other customer of theirs willing to buy it. Now, here's the problem. The subprime, I hate oversimplifying this because the mortgage-backed securities market has been around a long time. You can trace it pretty much back to Ginnie Mae, who started issuing mortgage-backed securities back in 1970. But here's the issue. With a Ginnie Mae or Fannie Mae or Freddie Mac mortgage-backed security, all you worry about is trying to guess how fast the homeowners are going to prepay their mortgages. Because depending upon the prepayment speed you choose is going to determine the lifespan of the investment and going to determine the treasury that it should be priced off of. When you deal with securities, like these mortgage-backed securities, backed by these subprime mortgages, you still need to guess what kind of a prepayment speed you're going to expect. And that's going to determine the life. But that's only one half of the equation. The other half of the equation is you have to be able to estimate, because let's remind ourselves of something. Ginnie Mae, Fannie Mae, and Freddie Mac all guarantee you your principal and interest. You are totally worry-free with regards to credit risk. With these subprime private label mortgage-backed securities, you have to factor in what percentage of my principal am I not going to recover? Because these homeowners default on their mortgages, their mortgage goes into foreclosure, and the house gets auctioned off. You have to pick that number. The thing is, the mortgage-backed securities market, I just said, is 37, 38 years old. There's a, literal ocean of data regarding if interest rates were to go up 1% or down 1%. You can fairly accurately predict the effect that'll have on the prepayments. The problem is the subprime mortgage market is how old? A couple years? A few years? And the thing is, we factored in some amount of defaults back in the day when these securities were first issued and bought. The problem is, obviously, the real estate market and the default ratio and foreclosures seem to be running at a lot faster speed than anybody could have predicted. The thing is, when you price these securities, you have to put those numbers I just said in. Prepayment speed, and what do I think the default rate's going to be. The problem is, I don't know if I can, with any confidence at all, guess what the default rate's going to be. And if I can't guess that, that's my first input into my pricing model. If I can't trust that input, how do I possibly trust the result? And you can't. And I'll tell you something, and I spent, 8 years dealing with this as a salesman. Brokers try very hard to give you a bid, meaning you call the broker to sell something you own. The thing is this, it's a scary moment when you call a broker to potentially sell something you own and they won't give you a bid. Panic can ensue at that point because you're potentially looking at a security that there's no market for. So they'll try very hard to just give you a bid. It might be a crappy bid, but at least it's a bid. The problem lately has been brokers are unwilling to even give you a bid for fear of taking those products into their own inventory. These big write-downs you've been seeing by, I won't list the names, everyone knows the names, is a result of that. That they have these securities in their own inventory and now have a very different viewpoint on what they're worth. And the problem with the bond market is, it is not like the stock market. I mean, I'm actually filming this on a Monday. It's actually Monday, if you care, January 7th. If stock market investors woke up this morning and decided that stocks were overvalued, it would be newsworthy, it would be dramatic. But I wouldn't even be that surprised if by Friday of this week, the Dow Jones Industrials could fall by over 1,000 points, maybe even 2,000. The stock market can do that. Just rip the Band-Aid off and reprice stocks, and a week from today, next Monday, the stock market is appropriately priced. The problem with the bond market is the information comes in drips and drabs, and it may be another year. Eventually the picture will be clear and obvious. It's not now. So I hate saying that on January 7th, but this credit situation is going to drag on for an extremely long period of time. And a lot is going on in the economy. I'm writing about it in my newsletter I just took a break from writing it. I'm going to talk a little bit more about that in my newsletter. But it's going to take time, and there's going to be an impact on the economy. So that's how I'll leave this. I hate to oversimplify, but the simple problem that we're having is that far too many people were lent money during the last 5 years that should have never been lent it. And we have to now digest this and move past it. So I was very unreliable with regard to my newsletter and my video commentaries last year. I plan to change that this year. I miss doing it. It's a good outlet for me, and I love helping people learn anything new. So I hope you're all well. I'm going to go back. I live in Connecticut, as some of you probably know, and back to my global warming thing. They say that by the end of my lifetime, Connecticut's climate is going to be like the Carolinas, which, again, I'm against global warming, but that sounds good to me. That'll save me having to move. Anyway, you go do your thing. I will see you back here next month, and we'll talk about a brand new topic. You take care.